Welcome to Industry Insights with Route Consultant, your front row seat to the fast-moving world of logistics and beyond. Each week, we bring you game-changing insights, real-world strategies, and fresh perspectives to fuel smarter investments and build stronger businesses. Join us as we sit down with expert guests to explore emerging trends and pressing topics across a wide range of industries. This is Industry Insights. Hey everyone, welcome to Industry Insights. This is a special episode that was actually recorded live at the Route Consultant Expo in 2026. We're releasing this over time so that if you weren't at the Expo, or if you missed the session, or if you're just catching up, these are all coming out over the course of the year so that you can go back and watch this content and make sure that you see everything that we went over at the Expo. Today, you're going to hear from Kevin Brunner, the founder of Sell My FDX, and you can learn all about the tax strategies you'll need as you plan your exit.
And my name's Kevin Brunner, and I'm the founder of something called the Q Companies, and it's a series of financial firms that provide complementary services between the different companies. And one of our lead programs is something called the 537 Installment Sale Trust. The number 537 comes from an IRS publication that actually tells you exactly how to do what it is we're doing. And we're following the installment sale provisions of the tax code. So many of you have thought about maybe selling your business or maybe bought a business where the seller carries back and self-finances. Well, you don't have to do it that way. You see, do you really want to sell to somebody that can't get financing? You know, if they can't get financing, should you be giving them credit? Also, you have more risk self-financing. Plus, with the trust, we can engineer a transaction, and I'll get into that lightly at the 10,000 foot level. We can engineer a transaction that gives better terms to both sides of the transaction. So my first FedEx contractor, and we'll get into more of this in a second, came in 2012. And that's when I got introduced to working with this. And he was going to owe so much in taxes, and he had to pay off some trucks, that by the time he paid the commissions, the fees, the taxes, everything else, he had to write a check to sell his routes. So it literally was not a viable transaction. I started doing these back in 2004. I was taught how to do this by Ernst & Young tax attorneys. So you're going to run into some CPAs and some other people that haven't heard of this, and they're going to say, no, you'll get audited, everything else. The IRS has a publication and a Form 6252 for reporting when you've done it. So it's a very, very straightforward program. It's not as complicated as it sounds. You're all going to have individual questions. Use my business card there. You can email questions. We'll answer them back. But just think of this as you sell to the trust sells to the final buyer, the money comes back to the trust. We'll show you a flow chart on this. The money's got to go somewhere at close of escrow. You don't walk out of escrow with a suitcase of cash and stick it under the bed, right? If it goes to your trust account, there's no taxes due. If it goes to you, the taxes are owed. That's it. And you only pay tax as you get the income. Then you can reinvest from the trust into other things. So it frees up one of the biggest problems in selling a business, and that's the tax. It doesn't eliminate the tax, it just defers the tax. And that gives you time to do tax planning and work on that. But as long as the taxes stay deferred, the money stays invested, earning a rate of return for you. So you get to redeploy that capital again and again. Any real estate investors in the room? You guys understand what a 1031 exchange is? This is a 1031 effectively for selling a business. That's all we're doing, and that's why the IRS has no problem with any of it. So I have one PLR. We just submitted another PLR. Those are private letter rulings to the IRS on how this works. Anybody remember when Mitt Romney was running for office? You remember the big deal about he didn't pay taxes on $100 million from Bain Capital and loopholes for the rich, right? Well, first off, the minute you hear the word loophole, that's a political statement. There's no such thing as a loophole. You're either following the rules or you're not. That's it. All right, so Ernst & Young deferred the tax on his partnership using a special purpose trust. Exactly what we're doing, because Ernst & Young does those in mergers and acquisition deals. So they set these up for the people exiting an M&A deal. So their exit lands in a trust, all right? And then they take an income stream from that over time. That's all that happened. At one point during the election, I actually, because of public information, I was able to get a copy of the plan Ernst & Young did for Mitt Romney. And for guys like me, that was like reading a sheet of Mozart's music. All right. Now, you guys, as my wife said, she reads that stuff to fall asleep. I'm actually the guy that reads that stuff and finds it interesting, all right? But the plan's not overly complicated. I've done over 3,800 transactions. I actually at one point owned a business brokerage with 44 business brokers and 33 franchisee offices nationwide. And we used the installment sale trust to engineer transactions where the transaction simply would not have been possible without this because of the taxes. Now, I'm in California, so that it's the highest tax state there is. So there's a lot of small business owners can't sell their business because of the tax. They're stranded. So that's why they don't sell, and they just, and one day they carry them out boots first, right? You know, so 47 million plus first year tax savings. We haven't calculated the total tax savings over time, but it's hundreds of millions, all right? Been doing these things for about 30 years all in, 20 years as an advisor. All right. I bought my financial advisor's practice because I was a defense contractor and got tired of the travel. And that's how I became a financial advisor, kind of backed into this the other way around. Over 2,000 happy clients. Now you see 3,800 transactions, 2,000 clients. What's the delta there? You can do unlimited transactions into the trust. So imagine you have 3 groups of routes and you want to sell one group here into the trust. You can later sell another and another. So you can do unlimited transactions through the trust, all right? This is just a small selection of our team. I was sharing with these gentlemen here. In November, we had our annual planning for 2026. We do that with the team every year in Montecito there in Santa Barbara. And I was looking around the conference table, and in business, all the years I've been in business, the many things I've owned, built, sold, I've never had a team of people around me like I have today. I'm incredibly grateful for the people I have. So, like Morris Chubb, the gentleman standing there at the back, he's been the CFO for NASDAQ companies. So Craig Redler is an internationally respected trust attorney. He gets paid $10,000 a day to lecture internationally in Lisbon and Athens and places like that to international trust attorneys. So Christian Ramsey, he's an accredited investment fiduciary. So we're actually registered with the SEC, Blue Sky, Nationwide, the whole thing. So we function as fiduciaries as well. So just the team of people that we have, and this is just a selection of them, tremendous resources, tremendous. We've started bringing all of our services in-house. When I first started doing this in 2004, the fees were pretty expensive, almost 3% a year to maintain all of this, because we had to pay outside law firms and outside CPA firms and outside money managers. So over 20 years, I've been bringing these companies in-house to get the fees down. So since 2004, our fees are now half what they were in 2004, just because we're getting fingers out of the pie. Okay, so it's become a very efficient business. These are some of our partner companies, IST Admin Services and CB Admin Services. These are corporate trustee services. So once you set up a trust, there is a corporate trustee that goes on forever managing these things. So none of this is dependent on me, Morris, any one of us. When I retire, you'll be dealing with Trevor and Christian. You know, so this goes on for generations. I have 2 families on the 3rd generation. We have over 40 families on the 2nd generation. So this can become a legacy for your family at some point. You're either looking for an exit or you're planning for your exit. We will consult you on that, how you want to arrange things, what the math looks like, what your income going to be on the other side of the exit. While you're selling, you're thinking, wait a minute, how do I replace my income? We are also income planners as financial advisors. We can help you with all of that. But if you're here as an investor, you're looking to buy, you want us to help you with that as well. Because having the trust intermediate the transaction can free up revenue on both sides of the transaction. We can create better terms for the buyer and the seller that make the deal viable. For example, maybe you need the seller to carry back 10% on your SBA financing. Well, if he's already losing 35% to taxes, state and federal, and now you want him to carry back another 10, he's probably going to say no and tell the broker, find me a better buyer. That happens all the time. But if there's no taxes on the sale or they're deferred, it's not so hard to do a carryback or a little bit of self-financing on the trucks or something of that nature. So it frees up that money and frees up that stress to design a better transaction. And being I've managed hundreds of business brokers, thousands of transactions. We have a lot of experience to give you ideas how to engineer that transaction to give both sides what they want. Something most of you might not think about is, for example, you've depreciated the trucks down to $5,000, but that truck's worth maybe $45,000. The buyer wants to buy it for $45,000 because he wants to redepreciate. You don't want to sell it for $45,000 because you don't want to recapture that depreciation and pay tax on it. You can sell the truck to the trust for $5,000. The trust sells it to the new buyer for $45,000, and we just reduce the amount of goodwill on the asset purchase agreement. We just rearrange the numbers. This is how Bain Capital uses these trusts to intermediate a merger and acquisition deal. Because it's a dollar in, dollar out to the trust, so it doesn't matter to the trust. But it's a big deal for you on recapturing depreciation. And it's a big deal for the buyer. If he buys it for the $5,000, he can't redepreciate it. So those are just some of the little details that we can resolve, giving both sides of the transaction what they want. There's even a method to do a stock sale to the trust and an asset sale to the buyer. All right, so there's many ways to solve these problems, okay? But by having the trust intermediate the transaction, even if you're the buyer or the seller, we can help both sides by involving us in the transaction. The whole goal is to maximize income. Life functions on income. As a financial advisor, I've always focused on how to maximize income from the existing assets. Rate of return on investments does not equate income. I've seen accounts that average 12 that generate less income over time than an account that averages 8. Well, how could 8 be 12? Because the 8's consistent and the 12 is volatile. So if you're pulling money out of your investments in a volatile account, when it's down, you pull money out, you're farther down. You have less principal to recover. How many of us remember 2008? See? All right. So your advisor called you up and said, hey, you need to cut back. You can't spend so much, or, we're selling at a loss. So we have strategies to make sure that your income from the trust never causes a loss. All right, and we can get into that in what's called Model Q. It's a white paper I wrote in 2004 that got published in Forbes. It's a financial plan that outperforms the S&P, and it has only 2 moving parts. 50% of the money's principally insured. And they told me, you can't do that, and I proved you could. And they didn't believe me, and in 2008, I gained clients, I didn't lose clients. So the same firm that disagreed with me hired me back to train their advisors nationwide on how to use the same strategy that I left because they wouldn't let me use it. By the way, I borrowed the strategy from a 1971 E.F. Hutton training manual. Remember the guy that beat everybody in the market for 30 years? Yeah. Why don't they use his strategies today? We use those strategies still today. Because the securities broker-dealers make less money if you do it that way. So the advisor's not allowed to do it. We are independent advisors. We answer to the SEC and to our client. So we don't have all the intermediary stuff that's interfering with that. So we focus on maximizing income and not chasing return. But to do that, you have to minimize taxes. Now, we get into the tax thing and people get all nervous, but I don't want to get audited. I don't want to get audited. No, it's not about that. It's about honest, straightforward, thoughtful tax planning. And in our theory, the way we practice is taxes are an expense. I mean, how many of us turn the heater down to 68 or 65 at night, right? I drove a Prius for 11 years. Everybody teased me about it. 48 miles to the gallon, that stupid little car always ran. I drove it till it literally fell apart, right? Why? 48 miles to the gallon, and I'm driving a lot of miles. So we do all kinds of things to control expenses. You can do the same thing with taxes. If you're thoughtful and you have a tax planning type CPA, there's two types of CPAs out there. The one that says, no, 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 just pay, and the one that does thoughtful planning every year. If your CPA is not doing a specimen return with you in September, October to do some end-of-year planning to make sure next April's better, you need a new CPA, all right? That's a standard part of what we provide to clients. We want to defer the tax, keep the money working, maximize income, minimize expenses. Taxes are just an expense. By the way, sometimes we sound like we're anti-tax people. I'm not. I like having fire and roads and police and schools, and no, I'm not against taxes. I'm against inefficiencies. So the 10,000 foot level, how we think and how we approach all this, what is the most efficient way for income, for management, for selling the business? It's all about the efficiencies of these things. So we want to maximize income, minimize taxes and expenses, all right? This is how a transaction works. We simply set up the trust for you, and we like to do that before you've opened escrow, by the way, because there's some amendments to the asset purchase agreement. At close of escrow, the money, instead of going directly to you, goes to your trust. There's no taxes due. The trust is secured by an installment note that collateralizes the entire trust. You don't own the trust, you can't own the trust, and you can't be the trustee. That would cause it to be taxable. It's called constructive receipt in the tax code. That's our responsibility. But it's also our responsibility to make all this work. So you're handing off a lot of liability to us for less than what you pay Wells Fargo to manage your IRA account. But we're doing all this other back office stuff. The money lands in the trust account, and you get an installment payment. Now, the installment payments can be adjusted over time. There's a lot of flexibility in there. So you get a 6% income stream plus growth. Please focus on the plus growth part, because the plus growth is bigger than the 6%. All right, so you get an income stream. Then you call me up one day and say, hey, I have a chance to be an investor owner in this other line haul deal. Well, then the trustee buys an interest in that. So you get to redeploy the money, bring it back, redeploy the money, bring it back. There's some rules you got to follow, but that's our job, to keep you in compliance with all those rules. We don't charge extra. All of that consulting is included in what you're paying us to manage the trust, okay? You're now earning not only a rate of return on the money, your net, but the taxes that haven't been paid yet. The money stays invested. So by using the trust, even net of the expenses of the trust, it can be a 30 to 40% better outcome in retirement than had you just taken the money, paid the tax, and got it over with. I like using the metaphor. You've heard of Usain Bolt, the really fast runner, right? Okay. I'm an old man. I've had a heart attack and open heart surgery. If I start the race far enough down the track, I can beat him to the finish line. Plus, he has to stop every year, back up, that's paying the taxes, and then start running again. I don't have to pay the taxes, and I don't have to run as fast as he is to hit the finish line, because I don't have all that burden, and I started farther down the track. Same thing here. You're funding the trust with all the money. All of it's invested, all of it's earning a rate of return. Taxes are only paid when you take income. And we do tax planning, or the CPAs we work with do tax planning every year to make the taxes on that income half of what they would have been otherwise. We have a whole quiver full of arrows, ideas, and each person chooses the strategies that they're comfortable with. Some of the strategies we use to reduce your taxes every year create income from the things you've invested in. Now the client's coming back, wait a minute. I bought that for the tax deduction because you got a 5-for-1 exchange. Now I got more income. I go, that's a nice problem to have. Let's work on those taxes too, right? So, but by being able to defer and keep the money working Everybody benefits. You benefit, even the government benefits. The longer this money stays working in the economy, the better it is for everybody.
Hey guys, we just wanted to pause for a moment to invite you to our free events that are happening throughout the year. Whether you're just getting started in the logistics industry or you're looking to optimize your current operation, Route Consultant has events that are designed specifically for you. So head on over to routeconsultant.com/events or check out our show notes to register for free today. Also, while you're here, don't forget to like and subscribe to the Industry Insights with Route Consultant podcast so that you don't miss out on the stories, the advice, and the updates that are happening throughout the industry. We appreciate you being here and hope to meet you in person soon. Now let's get back to the episode.
Anybody here have a self-directed IRA? Yeah, it feels like you just have a self-directed IRA. Sometimes people say it feels like I have an annuity because the money's safe, it's secure, I get an income stream, but if I need some liquidity, I can also get some liquidity, all right? Or just another bank account. Great question. He said, you say it defers taxes, but if you defer it till you die, do you get a step up in basis? Yes, you do. And that's another thing that we have to talk about with the CPAs. They always want to say, no, it's income in respect to decedent. It's got to be taxed when you die. Not the note that we have. The note we have is considered under tax law a security, and securities receive a step up in basis at your passing, just like your Apple stock. Same thing. We do a lot of real estate. People exiting don't want to be landlords in California and places like that anymore. And they're always worried they're giving up their step up in basis on real estate upon their passing. Do most of you know what step up in basis is? Good. All right. So when you pass, the asset's reappraised at the day of your passing, and that becomes the new basis. All right. So in this strategy, whatever the valuation of the trust is on the day you pass, or you and your wife both pass if you're married, that's the new valuation to the kids. Now, the only clients we lose are the children. So if you don't integrate this into your estate planning, what will happen is you'll pass away and the kids are going to pull all the money out tax-free and buy a Ferrari and party and whatever else, right? So I've got 4 kids. One, she'll hold on to every dollar. She doesn't buy anything unless it's on sale. She's pretty tight. The other 2 are reasonable, but I got one, I promise you, she'll be broke by noon. So she takes in every stray dog. She gives something to every charity. She can't pass anybody on the street without giving them $20, every homeless person. I think they sit down the street from her house on purpose, right? So I finally found a vet that will take care of the dog. And then they donate the dog after she trains the dog to little old ladies and people that need a companion, right? So I finally got her doing a nonprofit, so I got to quit paying the vet bills and all these 3-legged dogs she keeps finding. So, no, but you can set things up to protect your children from themselves. For example, you can set up the estate planning on the other side of this to have generation skipping. We can talk about that, or even have divorce protection. So when that kid marries somebody you know from experience they probably shouldn't have married, when that falls apart, they're not going to be able to touch half of this. So this can fold very nicely into a legacy plan. And it's all being funded by the taxes that didn't get paid. The question is, how's the income treated that comes out of the trust? It's ordinary income as it comes out of the trust, unless you take a distribution from the trust of basis. Now, that could be either tax-free or gains taxed, and it depends. But it's our job to advise you on that. So whenever you come to us and say, I need to do this or I need to do that, tell me what it is you want to accomplish, and then we'll tell you how to engineer the transaction, staying within the tax code to get what it is you want. But it's ordinary income from the trust. It feels like having a fat pension, is what it really feels like. So let's say you gave us $1 million and we're sending you the 6%. That's the standard income stream that's on the note. And you call me up one day and say, hey, Kev, you guys have been doing well. You got $1.4 million in there. I go, yeah. He goes, I'd like to get $100,000 out and a new note at 6% on $1.3 million. Because you want to buy a new RV and take the grandkids on a tour of the national parks or something. I had a client did that. And it ended up being a great thing. So we sent him 100 grand. He got a new note. It's DocuSign. We send you a new note. It's refinanced immediately, and now you're getting 6% on $1.3 million. So the reason we do it that way is if you're getting $10,000 a month right now, in 15 years, $10,000 a month, that's beer money, right? With inflation. So we want the trust to compound over time and for the income to go up over time to keep up with inflation. Also, having the delta there between the 6 and what we don't earn that every year. There's some volatility. I don't have to worry about the volatility because over time the average takes care of itself. All right. Here's an example, Steve and Kathy. The purchase price was $1 million, current value $5 million, 6% cap rate. This is actually a piece of real estate model here. There would have been a recapture, but the pre-IST net income was 110. They sold for the 5. They collected 4.25 after debt returned. They paid no gains tax. Had $250 a year available for income. That's more income than they would have had they not done this or even kept the property. They used a portion of it to buy a vacation home in Costa Rica, and at age 60 receive a lifetime income payments of $293 a year per year. And they saved approximately $2.5 million in estate tax because this is outside their estate. All right? So by structuring a deal like this, it opens up all kinds of opportunities with the taxes that weren't paid because the taxes aren't due. There's no taxable event until you receive the distribution. So we just engineer so there's no taxable event. By the way, the money inside the trust also grows tax deferred, kind of like an IRA. It's not a qualified account like an IRA. But because of the nature of the trust and the operating agreement in the trust, it doesn't owe any taxes. So it's all deferred until you pull it out. A second case study. They bought it in 96 for $1 million, sold it for $3 million. Cap rate is 6. This is another real estate example. But $500,000 recapture, $60,000 a year was their pre-installment sale trust income. They sold for the 3, collected 1.25 after debt. Capital gains tax owed over 21 years instead of during the year of the sale. So what they did was they did a spend down. So you can do that also. You can have a principal and interest note. You don't have to have an interest-only note. So I have had some FedEx contractors that sold for, like $900,000. They had investment properties. They had other income. The wife had a pension. She worked for a government agency. So they just took a 20-year income stream, principal and interest over time. And if you do that, it's a 7.5% interest rate. And then you get a fixed payment. Now, you can't adjust those. You can't refinance those. It's a fixed payment model. But that is one of the things we can do. So you get a blend of principal and interest spread out over a number of years. You guys have got the book. You can go to the website. You can put together your questions. You'll notice you'll get emails back from me at 11 at night because in the evenings I go into the office and I read the questions. I answer them back. We don't charge up front for consulting you. We don't charge up front for the trust. We can't. If you paid us to establish the trust, you would have violated the arm's length in the transaction that's required to be there for the tax deferral. So you don't pay us. We get paid when the trust gets funded. So we have every interest in helping you engineer a transaction that closes. Okay, so our interests are aligned. Sometimes we don't even use the installment sale trust. It's a simple program. It's outstanding. It's not complicated. The IRS has no problem with it. They even like it. Okay, it's a revocable trust. You can terminate and leave anytime you want. The door's open. We'll help you fill out the forms. Nobody's ever done it, but we know how to do it if you wanted to, okay? But sometimes we will work with you and we'll find another method We have a dozen other methods for tax planning on exiting, and sometimes there's other methods that are more efficient and easier for you, and we'll recommend one of those instead. So this isn't the only thing that we do. We have dozens of other programs. Anybody hear of the charitable trust? Doing a charitable trust? Yeah. The math never works out on those exactly as planned. They're highly audited because people fudge and they don't take care of their... A trust has a book like a corporate book. And if you don't maintain that book, if the IRS shows up and audits you, they collapse the trust and it's taxes, penalties, and interest back to day one. And that's why we do the charitable trust model as well. We layer that over an installment sale trust. So the first 5 or 10 million, depending, goes into the installment sale trust. The rest goes to a charitable trust. And there are benefits of doing those. The math doesn't work unless you're layering it. Then the math works. But we only do them if you hire us to be the trustee of the charitable trust, because we don't trust you to keep it straight. And when you get audited later, you're going to come back and file a claim against my fidelity bond or my malpractice insurance because I recommended you do this, right? So we only take you. Now, if the IRS sees that a professional trustee is managing that trust, that charitable trust, they're not going to audit you. They're not going to bother. It's a waste of their time. But I've talked to the IRS auditors. They watch charitable trusts. They wait till the 4th year, and that's when they do the audit because they know you've gotten lazy and not maintained your book and your records and stuff correctly. They actually target things specifically that way. There's nothing wrong with a charitable trust. They just know people aren't going to maintain or they commingle money inside of those things. So, but that is one of the strategies we use over and above this. But those are a little more expensive to maintain than this. But you do get some upfront deductions on those. So we will help you engineer a transaction that works into what you want the final outcome to be. Maybe you're just going to sell a few routes and keep the others, and you just want the money to stay in the trust and just grow for the future. We can do that as well. So it opens up all kinds of options. So if you're looking to buy, let us help you engineer a transaction for you and the seller. If you're looking to sell, we can engineer a transaction to maximize your exit. Okay. Any other questions? We have something called a Model Q, which is, oh, you're going to hand, oh, that's nice. Yeah, go ahead.
Oh, well, you can go first. Sir. So I had a quick question on the 537. Can that also be applied to stock as well? Just regular NASDAQ traded stock? Could you take a portfolio?
No, we have other methods that are simpler for that.
Okay, but same principle though in terms of you put that in a trust, you defer the tax exposure and...
Yeah, exactly.
Okay, thank you.
So, but no, one thing you can't do into the installment sale trust is publicly traded stock. That's one thing you can't do. But we have other methods for that that are as equally as simple. All right, yeah. And now a gentleman up here asked, what are the things typically invested in? Our standard model, we call Model Q. It's a white paper I wrote years ago. Half the money goes into an annuity, which is a terrible word. 95% of annuities out there shouldn't be sold, shouldn't exist. Nobody should ever buy them. But the good ones are extremely good. They're principally insured, and they make 7 to 9%. We use the annuity for income. The rest of the money goes into a managed portfolio of ETFs that's highly managed, traded daily. Don't ask me what ETFs are in it, because in an hour it'll be different. The rate of return earned on those ETFs is significant. We do very well on those. So here's how it works. The annuity is your guaranteed income. That check comes, it's a direct deposit, comes every quarter, no matter what, from an insured instrument that makes a reasonable rate of return. We wait till the market's up, we harvest gain. If the market's down, we wait. There is no loss till you book a loss. That is Model Q. That's the E.F. Hutton model from 1971. He used the stocks for growth and the annuity for income. So it's not that one is good or one is bad. How many of us took a screwdriver of our dad's and used it as a crowbar, and dad got pretty ticked off because now he had to go to Sears and get a new screwdriver, right? Nothing wrong with the screwdriver. It was the wrong tool for the wrong purpose. So when we look at financial instruments and investments, we're thinking, what is the right tool for the right purpose? So the wrong investment being used incorrectly, we can have a no matter how good of an investment it is, isn't going to work out. So you have to understand the investment and where it fits into the strategy. So we don't love or hate much of anything. We want to use the right tool for the right purpose. How well do we do? 10-4 to 15-1, long term, net of fees and expenses. We do very well, all right? It's because we're thoughtful and we're patient. For example, I like trading options. Most mornings I open the window, I see none of my patterns, I close the window and do something else, because you don't have to place a trade. I come back when I see my pattern. I met a guy here the other day who was teaching me stuff about options I didn't even know. Because I have a system, it works, I'm disciplined, I don't deviate. And you don't have to trade. So if we make arrangements in the trust that the income comes every quarter from guaranteed instruments, Pacific Life, Nationwide, people like that, they're not going anywhere. And then we use the market for growth and the insurance for income. I'm not going to be embarrassed in 10 years when you come back to refinance the note and up your income. That's why we do it that way, all right? You can deviate from our standard model. You can invest in most anything inside this trust. Now, if you come to me with some crazy idea that you got from your buddies while playing golf, I'm probably going to tell you no. But you have the right to fire us. If we have an impasse on the assets and we disagree, it's never happened. So far, I've been able to talk everybody out of the crazy thing they wanted to invest in. Then I find out a year later that, yeah, I was playing golf with the guys again. The SEC seized all the money. They don't know when they're getting it back. It's like, yeah, I saw that coming. All right. So we're open to whatever investment you bring to us, because the trust is collateral for your note, and you have every right to dictate what you will and will not accept as collateral. You can't run the investments, that's constructive receipt, but you are in control via the note. You're not giving up control doing this, all right? You're just outsourcing a lot of the liability to us. Any more questions?
2 questions. So take an example where you bought for 2 million and sold for 5 million. Do you move the 3 million capital gains into the trust or the full 5 million?
Well, first off, you bought for 2, but you've been taking depreciation.
Yeah, let's simplify. No
Yeah, simplified. Simplified, if let's say you had no debt. You bought for 2, selling for 5. We'll just assume 2 is your basis. We can show you how to take the 2 tax-free and only put the 3 into the trust, the taxable portion into the trust. Now, in actual practice, it's never that simple, all right? There's usually some trucks that are leased or financed, or there's a line of credit, or you still haven't paid off the SBA, or you took one of those COVID loans and you still got to pay that back. There's usually something. But you are right. Whatever your basis is that's free, you can extract that and only put the taxable portion. So we can bifurcate that. So only the taxable portion goes into the trust. Yeah.
Second part of the question is, in a self-directed IRA, there are separate types where you can hold real estate. There are some specific for crypto, etc. Does your trust have that kind of flexibility, or is it only to common stock?
No, yes, it does. We will not get into being property managers. So when you buy that investment property, you're probably going to buy it in an LLC. The trust can become a member of the LLC. All right? And you can even be the manager of the LLC. Now, you better keep good records, and you better make sure if you take $1, let's say the trust owns 30%, you own 70. When there's a distribution from that LLC, you better send 30 cents to the trust and 70 cents to yourself. All right, so there's going to be heightened scrutiny on how you manage that LLC to make sure we remain tax compliant, okay? But can you do that? Yes, you can do that, yeah. What you're paying us for is to keep you compliant and manage these things. You're paying us so when you're in a home, don't know what day of the week it is, or like my mother that still thinks Ronald Reagan's president. She's 93. She'd been reading Tom Sawyer for about 3 months now. She has Alzheimer's. She has no idea what's going on. Her care is paid for by a trust, $16,000 a month, because that was pre-planned. So I get phone calls from the wife. You know, he had a stroke. He already had dementia. How am I going to pay for this? So this works nicely into all your future plans. So when we're planning with you, we're already thinking about that. Because odds are 100% one or both of you are going to need some form of long-term care at some point. And it's nice to leave something to the kids. Because let's face it, it's going to be a little harder for them to be millionaires than it was for us. It's not going to be as easy, all right? So if you can give them a leg up one way or the other, don't spoil them, make them earn it. But my grandfather bought me a lawnmower for my 12th birthday, then told me I had to make payments to him for the lawnmower. Yeah. Yeah, so I was a little upset. I wanted a 10-speed, you know. Remember that Santana 10-speed? That beautiful Santana 10-speed? Any guys my age will remember that, yeah. I was upset, but out of respect, I did what he told me to do. Looking back on it, what an ungrateful little shit I was. I had no idea the value of the lessons he was teaching me. So when you set these kind of arrangements up, you can make sure these things happen in the future. Make sure they don't have student loans. This folds very well into a legacy for your family. It also solves a lot of problems that happen to retirees later on in life, like my mother. You know, so I don't have to worry about that. Payment's made every month, and she's in a very nice place. She's always been very thin. She's actually gaining weight. We're all shocked. They feed her well, man. They feed her well. So 20 pounds didn't hurt her. She's always been very thin. So, but by making arrangements for those things, let's say you both decide to go parachuting on your 90th birthday and don't make it. It all passes to the kids with a step-up in basis. Or if you put it into estate plan, now they get income, the grandkids get income, the great-grandkids get income. One of my third-generation families, I mentored him in writing a business plan to buy a sport fishing boat, a very large one, 47 feet, out of San Diego. He now owns 3 boats and has a business doing sport fishing for tourists. He turned his hobby into a very profitable business. And the seed money came from his grandfather, who set up one of these when he sold an apartment building. So this can move nicely into a legacy. So be thinking farther down the road than just the transaction. Because when we're working with you, I'm not thinking about just your transaction. I'm thinking about when you're 65, when you're 75, when you're 85. All right? Any more questions? I must have done pretty well. I usually get more questions. Sandy here has a sheet here. If you put your name and your cell number, we'll text you to sign up for one of our webinars. Also on Friday mornings, I wasn't there today, but Friday mornings we have an open mic Q&A on a Zoom call. So we spend 2 hours just with an open Zoom room. People pop in, pop out, ask questions on Friday mornings. All right? So you can pull in and have questions. If you have a transaction coming up, buyer or seller, we'll review it with you and help you. You might not even use us. If you end up not retaining us for any reason, I charge you a tomahawk steak and a bottle of good bourbon, all right? So it's some of the cheapest consulting you'll ever get. My wife teases me. She says, you give away millions of dollars of advice for steak and bourbon. Honey, you know how many people just call me out of the blue? You know how many referrals I get? Boy, we'll help you with the transaction. We'll help you engineer a transaction. These people at Route Consult have tremendous resources also with other providers out here to help you stage yourself to be ready to sell. And I run into that all the time, where they'll come to me, I'm ready to sell. Their corporate book's a mess. They're behind on their tax returns, all kinds of things. So if you're thinking of selling, and you're going to sell within the next couple of years, you want to start planning. I have some FedEx contractors probably aren't going to sell for another 10 years. I meet with them twice a year. You know, they send me some Omaha steaks. And we got them thinking. We give them books to read, things like that to read, to get you thinking and staging yourself. A business that is always positioned for sale is a very efficient business.